Good morning and good afternoon, everybody. Thank you for joining us today, and a very happy new year to everybody that's on the call today. And I hope everybody had a great holiday season as well. So we've got a great agenda planned for you today. I have the agenda up. I'm going to kick it off with a quick 15-minute presentation on just giving you some RSP highlights, an RSP loan tip, and also 10 points that I learned from reading a great book, which I do recommend, The Psychology of Money. So I'll be going over that. And then after myself, we will have Eric Cameron with Manulife join us, and with award-winning portfolio manager Patrick Blaze. And at 155, sorry, we'll have the IA Wealth team, Hilda Ng from BC. Unfortunately, Angelina won't be with us today because she is traveling, but I believe she will be logging in. And also their award-winning portfolio manager, Maxime Hood, will be on as well. And then our final presenter will be George Iovankis, and George will be introduced by my esteemed colleague, Graeme Allan, who is on the call today as well. And George is going to be talking about Guaranteed Advantage, a very unique market-linked GIA. And then to summarize everything, Graham's going to put it all together and give us a summary of everything that was presented today. So let's get started. So our welcome once again, everybody, to our RSP and Wealth Team launch. My quick presentation today is just going to give you some RSP highlights. And I've got a quick RSP loan sales idea, which will help you as you talk to your clients during our RSP season. And also, I've got a great little 2 slides on how to manage your clients' money through their emotions. So I'm going to go over that as well. So just some RSP reference, some info, so you have it at your fingertips for 2024. The max is 31,560 or 18% of earned income for the previous year, whichever is lower. And for 2025, that amount is going to be going up to 32,490. So it's nicely increasing every year. And you can find your client's RSP limit on their notice of assessment, or you can have your clients log into their My Account on CRA. Again, any unused room can be carried forward indefinitely to the future years. And beware of penalties. There are penalties for excess contributions over and above 2,000, and those penalties can be quite steep. They're about 1% a month. And of course, clients that are members of a company pension plan, this will reduce their RSP limit. And there is a pension adjustment that is reported on the T4 slip. And currently, your clients can still access up to 60,000 under the home buyers plan, which must be repaid in 15 years. And also the lifelong learning plan for continued education that is still available, 20,000, and that must be repaid in 10 years. And of course, we have the great FHSA available now. Unfortunately, we don't have time to talk about FHSA, but again, FHSA is still available. And yes, you can do both FHSA and HBP at any given time. And here are a bit of stats. RSPs are still very relevant today in Canada. $55 billion goes into RSPs, so it's a big market. It's great for everyone on the call to be involved in it. Average contribution is about 4,000, and there's 1 in 5 Canadians that are making a contribution. So, 1 in 5, that's not bad. However, we like to point out that as income rises, higher income earners, 200,000 or higher, two and three of these individuals contribute to RSPs. So again, RSPs still very relevant today in Canada. Just a little sales tip here on how you can get more for your clients by just simply doing a little RSP loan. So a typical scenario, your client will have a certain amount of cash on hand, X amount to contribute or to top up their RSP. And I use an example here with a client that's in a 40% marginal tax rate. He or she's got, 10K cash on hand, but really wants to make a larger contribution. So in this situation, you can consider a $6,667 RSP loan. So total RSP contribution now is 16,667. And your client at a 40% marginal tax rate can use the tax refund of 6667 to pay off the loan. Now, of course, you must have discipline to do this. When the refund comes in, you can't go and buy a new entertainment system or big large screen TV or anything of that sort. But again, this concept works really well. And it's really a win-win situation. It helps you make a little bit of a larger sale. And also, it benefits your client with a larger RSP contribution. And of course, today, deposits and loans and opening up new accounts can be done from the comfort of your office. So again, very easy to do. And again, great strategy for your investors, your clients that want to make a larger first 60-day contribution, but have less cash on hand. And of course, they must have the RSP room. Today, tax returns that are e-filed, the refunds can come in less than 30 days. I've seen them come in as little as, 5 to 10 days. So the cost of borrowing for this strategy, is actually very minimal. You can definitely talk to Vic Ray, who is on our wealth and banking team, along with Jason Payne, the head of wealth and banking, and of course myself and Graeme Allan, who you hear from later today. So B2B is the lender for a number of the insurance companies, IA, and of course Manulife. They have their own loan system available for your clients. And of course, encourage your clients to continue with monthly dollar cost averaging programs. And also, we've always said to rebalance the portfolios that you set up, with new deposits or new monthly contributions. Because once you find out your clients, risk tolerance, time horizon, and you build a great portfolio for them, you really don't have to change the foundation that much. And again, any rebalancing should be done with monthly packs through dollar cost averaging, and of course, rebalancing with any new RSP cash or loan money. So the psychology of money, for those of you that haven't read this book, I really encourage you to do so. And some of you may know that my academic background is actually in psychology. So when I did read this book, I picked up 10 really great tips that I want to share with you today. And again, in the interest of time, I'm going to go over them pretty quickly. But again, my slides will be made available. So we've always said as financial advisors and planners, your job as an advisor is to manage your clients' emotions, not their money, because the money is managed by top portfolio managers like Patrick Blaise from Manulife and Maxime Hood from IA, who you hear from today. Right? So the first one is about luck and risk. Luck and risk are really twins. So you can't underestimate the role of luck in the financial successes that you all make. While skill and effort are important, unexpected things can happen and those will significantly impact the outcomes. So it also talks a little bit about the, risk reward analogy that is very prevalent in investing and of course the psychology of money. Number two, enough is enough. So you can focus on helping clients accumulate enough wealth to achieve their desired lifestyle, rather than having them chase unattainable goals or comparing themselves with others. It's the old keeping up with the Joneses next door. Compounding returns. Compound returns, one of the most powerful forces in the universe. And this story here has been around since I've been in the business over 35 years. It's about starting to save early and investing early to harness the power of compound returns. And your money will grow exponentially over time. And this is really the tale of two twins. So you have two twins, ages 20, let's call it a girl and a boy. The girl twin says, you know what? I'm going to start investing early. She starts at age 20, invests 3,000 a year for 7 years and stops. Like that's it. So she invested 21,000 over those years. So the second twin, who is now 27, let's call it the boy, and he says, you know what? I have to start saving. So the second twin starts saving the same 3,000, but now he saves for 38 years, a total of $114 until he's age 65. Now, at age 65, you crunch the numbers, both twins will have about $1 million, even though twin two, the boy, invested almost 6 times more. And this is a great little story to tell perhaps your younger clients, your clients' kids, grandkids, about, the power of compounding returns. Number four, willingness to be bored is a superpower. And what we're trying to say is, coach clients not to chase get rich quick schemes and really focus on the long-term strategy for building their wealth through patience and discipline. And again, your clients don't have to be financially literate to be wealthy. Financial success is more about the behavior and how you manage their behavior than the knowledge that they really need. So again, help them develop, healthy financial habits such as paying themselves first and avoiding impulsive decisions such as selling out for a loss. And we've seen it all when there's a herd mentality of everybody selling and they think they have to sell as well. Number six, freedom. Freedom is really more important than money. And aim to help your clients achieve financial independence, which gives them the freedom to really pursue what their passions are in life, on their own terms. Recently, a billionaire actually told me that he doesn't need that much money. And I think a lot about what he said, and I challenge you to all to do this as well. Number seven, beware of the hidden costs of lifestyle inflation. All of your clients, their incomes will increase, their net worth will increase, but really help them resist the urge to significantly increase their spending to maintain a new lifestyle. And also, never underestimate the power of patience. Building wealth takes time and consistent effort. And again, don't let short-term fluctuations in the market discourage your clients from really what your long-term goals that you've planned for them are. When there's dips, buy into the dips or at least hold steady. And also, when you rebalance, you have to rebalance very cautiously. And I'm going to quote something from what Mark Twain said, a famous philosopher. And this doesn't apply to your professional portfolio managers like Patrick or Maxime, who you hear from today. It's more for advisors and perhaps more so their clients. Well, and what Mark Twain said, an investment portfolio is like a bar of soap. The more you touch it, the smaller it gets. And that is really profound when you think about it more. Number nine, diversify by asset class. Real estate has been amazing out here in BC and in Ontario, a great asset class. Stocks, bonds, fixed income, you will find those in all of the segregated funds that you market. ETFs, alternative investments are out there as well. Crypto, if your clients do so desire. And of course, par, whole life, which have proven over the decades to be a really amazing asset class. So last but not least, really respect money and it will respect you. And also never forget what you're managing is your client's money. So every dollar accounts. So be accountable. Recommend products to your clients that will stand the test of time. And in our industry, our products have proven for over 100 years that they stand the test of time. Segregated funds, annuities, GIAs, and again, cash value life insurance. So again, thank you from the wealth and banking team. We had an amazing year in 2024. So thank you for everyone on the call for your business. Here's the contact info of our team. And what I'm going to do is I'm going to stop sharing and I am going to invite out Eric Cameron with Manulife. So Eric, come on out.
Hi, Alex.
Hey, Eric.
Hi,
Hello,
Alex.
Patrick. Yeah,
Hi, Alex. Hi, everyone.
great. So thanks for joining us again today. I know Patrick's got a very busy schedule. Patrick's going to be formally introduced by Eric Cameron. Eric is based out of Halifax with the Manulife Insured Wealth team. Eric's been with Manulife for 24 years, spending 18 years as a wholesaler. And Eric really enjoys interacting with advisors, finding the right solutions, recommending the right funds, recommending the right portfolio managers like Patrick. So, Eric, over to you. And thanks again for joining us.
Great. Thanks, Alex. Thanks, everyone, for attending, and thanks for giving us time today. I'm definitely going to introduce my colleague Patrick and introduce some funds I think everyone should have on their radar for this upcoming RSP season. But I wanted to briefly just announce, hopefully you've heard, but we've made some enhancements to our guaranteed investment product lineup with our Gift Select and our Manulife private investment pools. We've added a 7,500 option in those two products. We're very excited about that. We haven't really been in that space for a little while, so it's nice to be back in there, just being that it is about 35–40% of the market. So we're quite excited about that. It's a very simple, straightforward, but very competitive product. Again, it's an annual reset that's automated, so you don't have to worry about hitting a reset button. It's all done for you. It's done up to age 80. Again, that automatic reset up to age 80 on the anniversary date the contract was opened. And you can actually open up a contract up to age 85 with 100% death benefit and make subsequent deposits with 100% death benefit up to age 85 as well. As we position seg funds as an essential tool when it comes to non-reg individual estate planning, you always have to be conscious of the capital gains or realization of taxation. So when we designed this product, we made it very easy to upgrade your clients, say, from a 75/75 solution to a 7500, if that makes sense for them now. So if they have an existing Gift Select Investment Plus or Manulife Private Investment Pool, and they have 75/75, to move to the 7500 is just a switch. And as long as you stay within the same purchase option and fund, no gain or loss will be realized. So we made it easy for you to, again, for those existing clients, transition from that 75/75 to the 7500, making again easy. And again, with markets being as high as they are right now, it might be a good discussion to have with your existing clients and be able to lock in that growth from an estate planning perspective. So with that, again, I am going to introduce Patrick, but I just wanted to give a brief sort of scenario or synopsis of his team. Patrick, again, is a senior portfolio manager with Manulife Investment Management. He's been with us for 15 years, but in the industry for 25. And he leads the fundamental equity team, which is a key component to my business out here in Atlantic, Canada. We recommend them on the daily, and there's certain funds, again, I'll get into briefly that Patrick will expand on in his presentation. But the success of this team over the last 10 years has been incredible. So they've gone from managing a few $100 million to over $14 billion in that 10-year span. And there's definitely a reason for that. They manage 10 funds for Manulife Investment Management, and they're all 4- and 5-star funds, with the majority of them being 5-star. So you have an exceptional track record over that 10-year period. They also rate very highly on the sustainability scale, which has become more and more important, as we all know. So you have an excellent suite of funds that Patrick and his team manage, and they're very consistent. And the key with them is that risk-adjusted return is second to none. And the funds I kind of want to highlight before Patrick gets into the process and his market outlook. My favorite fund on his side, on the equity side, is the Fundamental Equity Fund. Again, this is a Canadian-focused equity fund. It's been around for over 10 years. And the track record on this versus the index and its peer group is exceptional. So typically when you're hiring an active manager, you want to ensure that, again, you're paying an MER, you want protection on the downside, and you want a good upside, right? So some of the stats on that Fundamental Equity Fund that Patrick manages, 10 out of the last 11 years, it beat the peer group and the index, which is incredible. The years that were down in that 10-year period, they outperformed 16% versus the index. And over that 10-year span, they outperformed the peer group by 42%. So these are very, very exceptional stats when it comes to, again, the index and the peer group. Now, my favorite fund that they manage is the Manulife Fundamental Balance class, which is a Canadian equity-focused balanced. Again, similar story, 10 of the last 11 years, they've outperformed the peer group and the index. On down markets over that 10-year period, they've outperformed by 11%. And over that 10-year on the downside, and they've outperformed peers over that 10-year period to the tune of 33%. So you see a consistent message, whether you look at their equity offering or this balanced in the fundamental balance class, consistent outperformance and excellent risk-adjusted returns. So again, these are two of their flagship funds, and we're proud to have them in the Gift Select as well as the Manulife private investment pools. So with that, I'll hand it over to Patrick, who will go through a market outlook, and he'll highlight and dig deeper into his process and a little bit more on these funds.
Great. Thank you, Eric. Hi, everyone. Happy New Year. Thanks for the introduction, Eric. I'll let Eric bring up the slide deck, and while he's doing that, maybe just give you a sense of what we're going to go through. I was asked to comment a little bit about the economy, what we think of the economy, and I'm happy to share my thoughts, but as well as talk about how we manage money and how when we manage money, sure, the economy is important, but at the end of the day, we want to deliver returns, but we want to deliver returns in the right way, which means managing the risk and the opportunities that are presented to us, and managing around an economy that I will say remains volatile and remains, I would say, challenging. So just to add on to Eric's comment about our funds, I'm not going to labor on the point, but if we just go down one slide, you'll see our lineup of slides. And as Eric mentioned, they're all 4 or 5 stars, with the majority being 5 stars. Today, we're going to talk about fundamental equity, fundamental balance, 2 of our flagship funds. I would also note that beyond the consistency that Eric mentioned, beyond the downside protection, and beyond the value that's been added over the 10 years, both funds actually won the Lipper Award for best fund in their categories over a 10-year basis. For those of you that may not know what the Lipper Awards are, think of it as the Oscars of the mutual fund industry. And actually, Fundamental Balance has actually won that award 3 years in a row. So we're quite proud of what we achieved. And I'm going to share with you how we get there. So let's talk a little bit about the economy. Those of you that heard me maybe over the last year or two would have heard me talk about a resilient economy, one where we actually thought fundamentals were actually quite good. And today I can say still resilient, but getting muddled. And the part that does concern us, that a lot of the positives are priced in. So Let's talk a little bit about where we're coming from, and then I'll get into what concerns us, right? I always like to think I'm an optimist, but I'm always careful. Today, I'm being more careful than most times, because at the end of the day, if you don't have valuation on your side, you are taking risks, so you better manage those risks well. So let's talk a little bit about the markets, the economy. If we just go down 2 slides, I mean, I don't think I'm telling you anything none of you know, don't know, which is markets have been fantastic, right? We're looking at 2 years in a row where we've gotten fantastic returns. Part of that's justified. Yeah, go back 2 years, markets were actually quite attractive. We had a very positive disposition on fundamentals and valuations. And you can actually see that in our balance funds, where we were significantly overweight equities. Fast forward after 2 years of outperformance, and you start to asking yourself questions, right? Like, how good is the economy, and what's priced in? Now, if I actually think about the economy, I still think things are actually pretty good, right? We've had, if we go to the next page, we'll see that inflation has come down materially. I think we've all experienced it, where we're not seeing the price increases that we were subject to previous years as inflation surged in a few years ago, and that's allowed governments to reduce central banks to reduce short-term interest rates, which has provided liquidity and a boost to investor sentiment, as we see on the next page. Combine that with the fact that maybe for some, surprisingly, GDP held up quite well. And at the end of the day, GDP drives growth, which drives revenues of companies, which drives, at the end of the day, the ability to grow earnings. And as we can see on the next page, GDP overall, globally, our view is has been quite good. Not just the U.S., but other parts of the economy. Now, without a doubt, we've recently seen some slowdown. How much of it is structural? We'll talk about that in a few seconds. But overall, the broad dynamics were actually quite good. To us, it wasn't necessarily a surprise. We like to think in simple terms, and at the end of the day, it really comes down to 3 things, which is, okay, what are how are consumers doing? How are companies doing, and how are governments doing? And if we look at consumers, they were in a good place, and they actually remain in a pretty good place. If we look at unemployment, for example, if we just go to the next page, we'll see that, yeah, unemployment has backed up a bit over the last little while, but it's still in quite at a low level. And recent stats actually point to job vacancies actually being up in the US, surprisingly so. The stat came out yesterday. So unemployment is sure trending up, but it's still low, and it's trending up in a very gradual pace, especially in the US. But just as importantly, people are still getting good wage gains. Wage gains are still trending ahead of inflation, as we can see on the next page. And that just means that whoever's working is richer. So he's employed, he's richer. That said, sentiment sometimes isn't that positive. That can be directed more to perception than anything else. Can be directed to the controversy surrounding the election. But that's in the past, and what you're seeing is you're actually seeing sentiment get positive in general. And even we're seeing tidbits that even those that are stressed, such as low income consumers who have a lot of debt, have subprime debts, their actually finances are actually getting better, where debt defaults are coming under control. So overall, still a pretty good picture. Some weakness, for example, the unemployment rate, not as good as it used to be. Job vacancies sure spurting up, but still not as strong as it used to be. But if we look at another side of the ledger, corporations on the next page, we'll see that the fascinating thing about companies is they've never been this profitable. Profitability is still on the high side. And I think personally, it's a reflection of companies incorporating a lot of technology, digitization to their operations, the ability to be quite flexible, pricing power given concentration in certain markets. But put that together and you're looking at a very profitable ecosystem, which means to us that there's a reason they're not actually reallocating resources, because they have the profitability to maintain their cost base and the profitability to invest to take advantage of opportunities. And if you actually look at the drivers of the economy, investment still remains on trend, right? You've seen a surge in AI. That's actually it's a reallocation of dollars, but we never had a drop in investment, just like we never had a drop in consumer consumption. So at the end of the day, consumers are in a good place, has kept on spending, and companies have continued on investing. And what makes us quite one of the drivers that makes us positive on the overall profitability of companies is actually on the next page is productivity. Now I'm talking about the US, I'm not talking about Canada. Canada is a different reality where we're just not as efficient. But in the US, productivity has surged up and it's proving to be sticky, recurring. And productivity is the real wealth generator at the end of the day. People get rich off of productivity. It means we're doing more with less, or at the end of the day, there's just more coming to each person. So we're quite positive on that aspect. And we think there's some sustainability to it, right? Like AI, the advancements in AI are incredible. Will it be as great as we think? Who knows, right? But at the end of the day, I don't think there's any doubt that there are use cases for it. It will make us more productive. And there's other items out there that can make us more just from a cost perspective, reducing our costs, right? Like, for example, new weight loss drugs, which might ease the burden on healthcare, quantum computing, which can make us even more productive. So I've talked about the positive, but I pointed out there has been some weaknesses. For example, unemployment is trending up. Another one as well is the fact that construction is weakening, and we can circle back to that. But I think that's linked really to two things. One of them is debt levels are high. If we look at the next page, we'll see that this is the number one risk that we worry about is our balance sheet on a global basis looks risky. We're more and more dependent on debt to drive growth. And we really see that in, for example, in the US budget deficit on the next page, where a lot of that growth that we've experienced over the last 2 years has actually been led by actually really strong government spending. And you really have to ask yourself, how long can this last, right? Meaning there's two ways that this introduces risk. One of them is, do bond investors at one point get worried and ask to be paid more? And given that we have so much debt, as you saw on the previous page, that cost can become excessive. Secondly, with this massive government spending, sure, things are great, but maybe we're growing faster than what we're capable of. And that leads to basically demand outstripping supply in various forms, right? And when I say demand outstripping supply, what it can mean is that inflation suddenly proves persistent. And if we go down 3 pages, you'll see that that's been the case, right? Inflation has come down. Central banks have reacted, lowered rates, but lo and behold, over the last few months, what we've learned is inflation rates aren't coming down as quickly as we initially thought they would, as the economy has normalized, as we've gone through the supply disruption of COVID. It's proving sticky. Part of it is probably because we're growing at a faster pace than we actually can, and it's introducing inflation pressures. And I think a lot of it can be pointed at government spending, which they're probably overspending. And in hindsight, let's face it, they probably overspent in times that were too good. They probably should have maintained more diligent, more finances that were more disciplined. Now, personally, I also believe that inflation is proving sticky because two of the big secular trends that drove inflation down are actually reversing. One of them is demographics. As a population, we're getting older. and not just here, but also in certain emerging markets. For example, China's demographic challenges are probably greater than North America, given that we have immigration, which has helped us to manage that demographic, that aging population, where we have less and less people working and putting more pressure, wage pressure, and pressure on the system. So demographics is working against us. And secondly, deglobalization. I mean, at the end of the day, with the reintroduction of Trump, that trend will probably persist and accelerate, where the world is deglobalizing, and a lot of that inflation coming down over the few decades was actually developed markets moving a lot of their production to emerging markets and take advantage of this low-cost labor. That is no longer the case. That's probably going to continue to reverse. Hence, what I believe will be sticky inflation pressures, and therefore higher interest rates. And higher interest rates are having an impact. As much as we can point to positives, we can also point to spaces of weakness, right? Where long-term unemployment, for example, in the US is extending. And that's concerning. That's where you get structural issues. We can also point to lower construction, which is just a result of higher interest rates. As much as the US has housing shortfall in various places, like in Canada, it's hard to afford at these levels and at these interest rates. Affordability is definitely on the lower end. So all that to say, the picture's muddled. But what isn't muddled is valuations. We can say, I think with confidence, that valuations are no longer cheap. If we go to the next page, you'll see that in the aggregate, we're reaching multiples that are definitely at the higher end. Even if we were to extract the Magnificent Seven out of the S&P 500, you'd see that, yeah, you'd get a little bit more valuation on your side, but you'd still be towards the higher end. Is it bubble territory? I would argue no, it's not bubble territory. So if you're not concerned about expensive valuations and you think people continue to bid stocks up because there's still liquidity in the system, even though it is being refrained by higher inflation that's causing interest rates to stay higher than maybe we anticipated. Maybe it can drive higher, but that's starting to be aggressive. And if you look on the next page, you'll see that in a lot of jurisdictions, a lot of regions, valuations are more expensive than they have been historically. There are pockets of value, like we can point to Europe, emerging markets. We are taking advantage of that as much as we can. For example, if you were to look at fundamental equity, fundamental balance 5-7 years ago, it was literally Canadian names, US names. Today, it's Canadian name, US names, and some European names, because we're finding great companies at with some valuation on their side in Europe. They want to take advantage of that, because our process is all about finding those great ideas, building a portfolio of 40-odd names that gives us a great risk-return profile to deliver that value that's expected of us. So just maybe in conclusion, what do we say? We're saying, listen, the economy is on sound footing, but there are risks. At the end of the day, the future is muddled, especially when you think about what is the impact of the Republicans' immigration policies or potential tariffs. There will be volatility. You have to be careful, because there's a lot of debt out there, and the reality is inflation is proving sticky and interest rates are high, which could lead to further deceleration in the economy. Are we overly worried? No. Not on the fundamentals, but we do have some worries is on valuations. Markets are expensive, so we want to be careful. So we're applying our process, which has proven over the years to deliver a lot of value in a consistent fashion. And the way we do that is we really build a portfolio of 40-odd names, well diversified, where we emphasize our best ideas. And if you look to the next page, it's an 8-person team, the fundamental equity team. So it's not just my team. Let's just go, sorry, one more, Eric. Just go down. Yeah, one more. There we are. So it's an 8-person team. experience, intelligent, passionate. But the thing that distinguishes us is really we believe in one thing, which is cash. Cash rules the world. What we're looking for are cash-rich companies, meaning companies that generate a lot of cash through their business, and companies we believe that will continue to generate that cash going forward. And what we think about is three things. On a cash basis, if we just go two slides further, is this a company that we believe will continue to generate cash? And it's one back. Is this a company that we believe will continue to generate cash and is a good quality business? And to us, that basically means when they invest in their business, are they making good cash on cash returns? Secondly, are we taking risks? Meaning, what could happen to those cash flows if things go wrong? And I think right now is kind of one of those precarious moments, right? Where, hey, maybe things can go wrong and you want to own the companies that generate resilient cash flows. And then thirdly, and just as importantly, do you have enough cash on your side? Meaning, is this company, are you buying those cash flows at an attractive price? And when we talk about cash flows, we're not talking about cash flows in 5-10 years. We want to own companies that generate cash today. So that's the way that I like to think about companies, how I invest is it's good business on a cash basis. Is it a company where I'm taking acceptable risks on a cash basis where that cash will prove resilient? And thirdly, am I buying that cash on the cheap? And if I can find those companies and emphasize those companies, then I think I can build a good portfolio. And that's what my team does. Every week, we meet and we find those cash-rich companies. Now, if we go back to the previous page, it takes a lot of work to find those cash-rich companies. This kind of gives you an idea of the work that's involved. We'll take the last 10 years of companies' financial statements, go through it, understand where's the cash coming from, where's it going, and make a whole bunch of adjustments on each one of those names to get to the real cash they generate. But if we do that and we do it right, then we can figure out those three things that I talked about, which were on the previous page or the next page, which was, is it a good enough business to buy? Secondly, how much risk am I taking? And do I have valuation on my side? And if I can find 40 odd names that meet those criteria, I know I can build a good portfolio, and I can build a good portfolio that potentially will deliver that consistency that we've been known to deliver in the past. If we just go, for example, to slide 25, just to give you an idea of the fundamental equity fund, you'll see that, yeah, like Eric said, it's beaten the average peer 10 of the last 11 years. When the markets were down 215, 218, 222, we significantly outperformed, actually added 16% of total outperformance in those periods. In over a 10-year period, we added 42% of outperformance relative to the average peer. Think about that. So for every $100 invested, we gave you an extra 42. But one thing I want to touch on before we go into a few minutes of questions is slide 29. And I think this shows you the power of combining a good fund with a good seg fund product with good guarantees. So what we're showing you here is the value of the resets of the new 75-100. So what you see in the blue line is the performance of the fundamental balance fund. And in the green line, you see where the fund resets to. And I think there's two notes to take away from this is if you're investing in a seg fund that's offering resets, you want a fund that goes up so that those resets click in and they reset at a higher value than previous. And what you want as well is a good guarantee that kicks in when it's important. So for example, over here, if we look in 222, if somebody would have passed away and the guarantee would have kicked in at a time when the market pulled back, they would have benefited from an extra $20,000 in mid-222 from having invested in that 75-100. So in certain times, it's true. It resets, you get value, and the value of that investment is at or slightly higher. But then certain times, especially market dislocation, where that guarantee kicks in and it provides a lot of value to the customer. But that's only possible if it's combined with the right fund that allows you to grow that reset and bring value to the table. And we think in this case, for example, the Fundamental Balance Fund, it's a fund that's proven that combined with the 75-100 adds a lot of value to your clients. On that note, I'll leave it there. You've heard about our thoughts about the economy, as well as how we invest. If you think about us, think about cash rich. And thirdly, about the value of our funds, especially combined with the new 75-100 Manulife offering. Eric, back to you. Any questions?
I see one here. Okay. Patrick, do you expect that earnings growth in the coming year may be able to support the current PE ratios?
I would say fundamentally, no. The market's expecting double-digit earnings per share growth. That usually trends down as people start optimistically. That usually trends down over time. I think the market's betting on a cyclical, everything going well and the cyclical upswing. And listen, I'm not saying it can't happen. Nobody can exactly predict the future, but we are starting to get into a world where it's a risky proposition, right? Because if that cyclical upswing, if everything going right doesn't happen, you don't have valuation on your side. So the way I like to think about it again is, listen, I'm an optimist. We're 100% invested in equities, in our pure equity funds, in our balanced funds. We have reasonable exposure to equities, but we're being careful. And that's always paid off for us, meaning, hey, if the market continues on climbing because there's liquidity in the system, or things even get fundamentally better, we'll participate. But if things go wrong, historically, we've shown that our focus on companies that generate cash today, that are quality businesses, where that cash is relatively resilient and where we're taking acceptable risk, tends to outperform. Not saying it's going to be positive. I'm saying it's going to provide some protection to the downside. And I think that's the best one can do. I'm not going to sit here and make promises that we're headed specifically in this direction. What I'm telling you is some of the fundamentals look good. There's some risk being introduced, but valuations are a real concern. So be careful out there. Invest, select wisely the names, build the right portfolio. And if you do that in the long term, you'll be much better off. But don't try to outguess the market. Just try to invest accordingly and build the right risk return profile. But I will say, I think earnings per share expectations seem to be on the high side and factoring in the best possible prospects given the backdrop. Well, thank you, Alex. Thank you, everybody.
Thanks a lot.
Everybody, good luck in 225.
Great. Thanks, Patrick. Thanks, Eric.
Thanks, guys.
Excellent. So we're just right on time here. So I'd like to call out to the stage Hilda Ng from IA, and also Maxime Hood, portfolio manager with IA, to come and join us out on stage here.
Good afternoon, Alex, and thanks for hosting us today.
Yes. Good afternoon, or I guess for some it's still good morning. So thank you, Hilda, and thank you, Maxime, for joining us today on our wealth launch. And firstly, I know Hilda's going to introduce Maxime, talk a little bit about Maxime's funds and process, and Maxime will go into the presentation. But yeah, it gives me great pleasure to have Hilda Ng on our call today. Hilda brings to us over 10 years of experience in financial services, and we've worked with her at IA for, I think it's almost 7 years now, and Hilda's been exceptional working with our advisors and their clients, building strong relationships and also helping our advisors achieve their goals and also increase their business and increase their book size on the investment side as well. So Hilda, thank you for supporting our advisors. I know your colleague Angelina Basra could not join us today as she is in transit, but many of you on the call do know Angelina Basra looking after the Ontario region. But before I welcome Hilda, I just want to let everybody know that one of Hilda's great achievements in this past year is she was named one of the top 50 women leaders in Vancouver in 2024 by womanweadmire.com. So congratulations for that, Hilda, and it really shows. So without further ado, Hilda, I would like to pass the stage over to you, and thank you again for having us, and thank you for bringing Maxime to the call today.
Well, thank you so much, Alex, for giving us this opportunity to speak today. It's been tremendous pleasure working with many of you. So for those of you who are not familiar with IA, I just wanted to take a few minutes to briefly introduce our platform to you. IA has been ranked #1 best-selling segregated funds net flows by a third-party Canadian research company, Market Sage. We are also #1 in net sales since 2016. Our reset option for 75-100 is superior than other companies. The death benefits reset is available past the age of 80 up to the client's 85th birthday. This is a huge plus for clients who are looking into doing estate planning. In addition, we have a couple of specialty funds on our platform that are advisors' absolute favorites, such as the Fidelity Insights, Fidelity Global Innovators, the US Equity BlackRock, and the US DAC Index, and of course, Meta Innovation. So today, I have the pleasure of having our portfolio manager, Maxime Hood, who manages the thematic innovation funds, to talk about his fund's philosophy. Maxime began his career at IA as an analyst in the fund oversight and management team, where he developed expertise in a range of investment styles and strategies. In his current role, he co-leads the US Thematic Innovation mandates, which he helped build. He holds a bachelor's degree in finance from Laval University, Quebec, and is also a CFA charter holder. So without further ado, I will pass on the stage to Maxime.
Thank you very much, Hilda, and good morning, good afternoon, everyone, and happy New Year. Before jumping in, what I'm looking to do today is go through why I do believe each portfolio should have a bit of a thematic exposure, and then go through the process, because even if the name of the fund would make you think that this is a super high growth fund, that would usually be focus on more a satellite position in your fund. The way we manage it is really on a risk-adjusted basis, and we focus a lot on risk. So I want to take some time on the process, and I want to finish by highlighting what are our expectations for teams in 2025. Talk about AI, obviously, which is a big theme driving the market. I won't focus too much on the economy, and actually, I was watching Patrick's presentation, and he did a fantastic job on the US, and I echo a lot of what he believed in terms of the economy. But I'll be happy to answer any question afterward on that subject. So let's just jump right into it. So I always like to start with this slide of what I call the wave of innovation. Just as human, it's impressive to see how far we've gone in the last decade, the last 100 years. But for me, where it gets really interesting and where everything changed, I would say, is when we in the fourth wave, when electronic was invented. And by electronic, what I call is interconnect circuit. So this is really the core of internet, the core of computing, and what was for me one of the biggest invention, because we've been able to scale that to a point now that we are today, and that's this scaling that allowed us to move from having a personal computer, having internet, having a smartphone, and now we're talking about AI. So just to give you in perspective, just to give you an idea, the first interconnect circuit, it had the size of a pinky thumbnail. So it was already small. It was invented in 1958. If you think today, it's at the atomic level. And if you look at the last chip that was invented by the last GPU from NVIDIA, for example, it's a chip that can sit in the palm of my hand, and they have more than 2 billion interconnect circuit. So really, that's the scaling that allowed us to increase compute. And so what I want you to remember about technology, about innovation, is that since this invention, we've seen an acceleration of growth because technology is building upon themselves. And when I think about AI right now, what is incredible is that I see this as a vector of growth that's going to bring us into what I believe will be the next leg after AI will be robotics, full self-driving, quantum computing. So it's really a vector of growth, and we're accelerating, and that can be seen by the time spent between those innovations that is really shrinking. So that's really a fundamental view that we have when we invest. Now, one question that you may ask is it profitable to invest in thematic, invest through innovation? And really what we can see, and you can see it on the slide, is that when we invest in thematic basket, we are able to find secular growth in the market, and investing through those thematic basket, through those innovation, has been extremely profitable over the year. We can see it in terms of just communication infrastructure. If you take from 1992 to 2000, you had annualized outperform 8% per year. Even the fossil fuel cycle, if you look at cloud e-commerce, it's been a good endeavor for multiple reasons. First of all, you have good growth, but also when innovation comes in, you usually create a new market, which is a greenfield that was not available before. Another way to look at it, and I quite like this one, is that if you look over the last 100 years, there's only 3% of the overall US security market that generated 100% of market return. So what that means is that there's a small cluster of companies that are able to capture the economic value in the economy. And those companies, when you dig into this 3%, that's generally companies that have adapted to technology change, to innovation, and that were able to be a leader in that front. So really, this is the core of our belief, and that's why I do believe that investing through thematic allowed us to provide alpha, and there should be some part of this in every portfolio. Now let's go through a bit of our investment process. So it's segmented into 4 ways. So first of all, we want to have what we call thematic alignment. So we want to invest in teams that we believe will drive secular growth in the coming years. And we're usually looking at 3 to 5 years on that front. We don't want to be too early in a team. We don't want to invest in something that's going to be coming in the next 10 years. So we want to see return on our investment. We want to see cash flow. We want fundamental strength. So in our research, we will look at the full supply chain of companies that are involved in a certain theme. We want to invest in the company that has strong financial return as a competitive advantage, and obviously durable growth. We want some quantitative input, so we want quality, we want valuation. We don't want to invest in something where valuation doesn't make sense. And obviously, usually when you invest through team, there is momentum. But the most important thing is, and for me, it's something that's differentiate us for the other thematic fund or innovation fund out there, is that we have a really strong focus on risk management. What that means is that when I invest into 2 buckets in my portfolio. One is innovation, wasn't thematic focus, but the other one is quality company that generate good free cash flow. And that over time, depending on my risk appetite, can fluctuate from 70% to 50%. So this is really a barbell strategy, and our goal is to be able to provide absolute return better than the S&P 500 over a full cycle. So we're really mindful of downside protection, but we want to give you this exposition to thematic and innovation. And another way to look at it is that our benchmark is actually the S&P 500 and not the NASDAQ. And we are not 50%, 60% invested in technology. That's not something we will ever be in the portfolio. So how do we invest is that we've generated 4 big buckets of investment. And under those 4 big teams, we have 40 buckets of team that we see evolving over time. So when you think about intelligent connectivity, it's really the impact and the adoption of technology through the consumer lens. So you'll see e-commerce, the platform with content, electric vehicle, fintech. The second one is enterprise digitization. It's really the transformation we've seen in enterprise with the adoption of the cloud, the software model, and obviously right now it's all about AI. The other one is next generation healthcare, so really all the breakthrough that we're seeing in healthcare. And lastly, the energy transition, or I could call it the energy revolution, but the transition to fossil fuel free or close to, and all the innovation that we're seeing right now in terms of energy. Now, again, I want to emphasize the fact that if you look at those 14, when I look at intelligent connectivity, this is communication and consumers and financial. This is not technology. Enterpriseization is where most of my technology investment will be. Next generation healthcare is specifically focused on healthcare, and energy transition is focused on material, industrial, and utilities. So through our teams, we are fully diversified by sector, and that's something that is quite important in terms of risk management for me. Now, when we look at a company, what is important for us is it's every time we invest and we look at deep dive on a company, we want to answer those what we call the 3 C's process. Is we want to have a company that has catalyst for growth. We want to invest in markets that are in secular growth, so that are growing. We want a company that has a competitive advantage, and we want a company that has the best product out there. The other part is quite important for us is the confidence in management. We want a good track record. We want a company that is good at deploying capital. But one that is extremely important is we want to make sure that they have a vision that is aligned with us and that is aligned with how we believe the technology will shape or the innovation will shape. The best example I like to give in that sense is Intel. If you look back in the 2000s, Intel was one of the crown jewel of US in terms of chip manufacturing. And if you look around 2004, 2005, Apple came in with their iPhone product, and Intel took the decision by thinking that the iPhone would be a fad to not invest in the chip for the iPhone and gave this market for Qualcomm. And if you look at the chart, you can clearly see that Intel has done close to nothing for the last 20 years. And we're actually to a point where there were rumors at the end of the year where Qualcomm would be looking at acquiring some part of Intel. So really vision in terms of adoption and disruption is key for us because if you miss those big disruption in technology, that could be extremely painful for a company, even if it's a good company. And lastly, we want to have conviction about valuation. We want to have a good intrinsic value. We want to invest where we see more upside than downside. And also we want to be early or in late adoption in what we call the hype cycle. So really that would be the summary in terms of how we invest. So if I had to summarize, we invest through team to have exposure to secular growth, but we do it in a measured manner. This is a fund that is exposed, is benched against the S&P 500 with a risk management focus in mind. So we do position this fund more as a core plus US equity product than a satellite high growth product, just by the risk management focus that we bring into it. Now let's talk about 2025 and the big thing that we're seeing. So where are we in AI? So I'd argue that in the last 2 years, we've been in what I would call the building phase. So there's multiple implications in the adoption of AI, but one of them is that we need to restructure and build a lot of data centers. So we've been in what I would call a small manufacturing revolution, where the manufacturer that we're trying to build is data center, and what they're building is actually intelligence for AI. So obviously, a lot of investment, and this chart highlighted quite well. This is the capex of the big six, and if actually you could include Oracle also in it, and it would be even higher. So we do expect that capex will continue this year. We do believe that if you look at our estimate right now, they're still too low, and we expect that it's going to increase by close to 25%, and we'll still be in growth mode in 2025. So we do expect that what we call the AI power supply chains will continue to work. So when you build a data center, first of all, you need GPUs instead of CPUs. That's why you've seen NVIDIA do so well. They were the sole provider in the world in 2023 of GPUs, and they are the leading provider. So we do believe that NVIDIA will continue to do well, not in the same magnitude that it did in the last 2 years, just because of valuation and just expectation that are embedded in the price, but we still believe that there is a good opportunity out there. If you look at their new Blackwell product, they're sold out to 2025, and now the question is, will they be able to grow in 2026? We still believe that they will be able, but what we're more interested is actually, if you look at down the supply chain, is once you build the data center, you need a lot of connectivity, you need a lot of power, because a normal GPU take 10 times more power than a CPU. So we're having a power surge in terms of demand. Actually, if you look at since 2000, the demand growth for power has been 0 in the US. And for the first time in the last 20 years, we're seeing a surge in demand for power because of AI of the magnitude of 3 to 5% per year. The first solution, and we've seen it last year, was nuclear. It's the best solution in terms of utility to be able to provide energy to data center because it's running 24/7. But right now we have mostly restarted all the nuclear plants that are available in the US, or will be restarting, and building a new data center, a new nuclear power plant will take a lot of time. So for us, the opportunity as we look into 2025 is actually natural gas. We're seeing a big surge in natural gas, and we do expect to see a demand inflection as base load needed is going to increase because of the data center demand. And this is something that we have in the US. We also have it in Canada, which is quite interesting. And it's the easiest thing that utility scale players are able to build and build fast. So we do expect that last year was the nuclear year. And if you look at the best performer in the S&P 500, it was actually Vistra, a nuclear power producer. This year, we do believe that we're going to see the same type of deal that we saw with the nuclear power producer. We're going to see them in natural gas also, which is going to be extremely positive, and we're going to see upward revision for those type of company in the market. So we're positive on that, but we're selecting our exposure in this supply chain through exposure to a company that I'll talk later, which is GE Vernova, that is actually the leader in providing gas turbine. Now, this is for the infrastructure bill. I always like to come back to the mobile adoption to think about AI, because the framework is pretty similar. When you think about AI, it's a bit of a continuation of the cloud adoption and the mobile adoption. And we're going through the same phases. So if you think about 2023, for me, was really the year of semiconductor. Last year was the year of infrastructure. And we do believe that as we move through 2025, what we're going to see is the implementation, commercialization. So we do believe that this year, when we look at who's going to be the winner of AI, first of all, we do believe it's going to be different than the last 2 years, and we do believe it's going to tilt more a bit into software. And we're already starting to see it where spending intention in software and in IT from enterprise in the US is creeping back up. And we're already seeing company like, yes, Microsoft, but company like Salesforce that's starting to have their agentic agent, Trello, Atlassian. So we're seeing a lot of company coming to market, and we do see a lot of opportunity out there. So we do believe that software will be an area of interest this year, because when we look at where we are in the adoption and the 5 level of agentic automation, we're just starting level 2. So I do believe we're going to see a lot of agentic agent out there that's going to help us in a day-to-day, and we will probably start to see a lot of people around you using it. What that means is that there's going to be a lot of disruption across software, across industries, but that also means productivity gain. And we do think that this part is probably the area that is the most underlooked, is that we do expect that similar to what we had in the 1990s, we're going to see a boost in productivity as we see AI adoption come in. So we're pretty positive on that front, but it's really going to be a stock picker market because there are going to be a lot of disruption. And we do believe that a lot of old software company that was just a layer on a database will be disrupted on cost. So we really need to be picky in our selection, but we do think this is extremely important as we look into next year. Lastly, I want to take some time to talk about President-elect Donald Trump and where we see opportunity and risk on that front. So one key thing that we believe, and Patrick illustrated a bit about in his presentation, is really what we call the reshoring, so deglobalization. So obviously Trump, what he really wants through tariff, you can see it on the graph from the left, is bring back global manufacturing in the US. And what you can see on the graph on the right is that, yes, we've seen a lot of pickup in manufacturing from AI, but the dark blue line is also picking up. And so we do expect that this will continue as companies try to bring back manufacturing in the US to make sure that they're not impacted by tariff. So this is an area that's going to be extremely positive. And there's also, on that front, there's a bucket of company that I'd say a bucket of company that are also exposed to AI, so they are really well exposed. So that's our focus in industrial company this year. We're positive about that. Now, just quickly on the economy, I'd say if compared to the last 2 years, I'd say the backdrop is still positive, but valuation is not on our side. What does that mean is that I do expect to see a bit more volatility. The performance of the S&P 500 should be driven by earning growth. And one area that I'm a bit concerned is that, similar to what Patrick said, I think that there's a lot of expectation in the back half of the year that we're going to have a cyclical recovery. And we're already seeing earning revision for technology in the Magnificent Seven being revised higher, but for the rest of the market to be revised lower. So I do expect that we're going to continue to navigate this narrow market for a bit until we start to see a bit of an inflection in cyclical recovery. That doesn't mean that we're going to have bad return on the market, but I do think that this part is to be considered also. In terms of risk, what we're really monitoring is tariff, because we do believe inflation is a bit more sticky and tariff could bring inflation higher. And lastly is what we call the DOGE, or the Department of Government Efficiency. That could bring decreased spending from the government that could affect some industry. So that's really the two areas that we see concerns so far. Just quickly, I want to maybe showcase two just in the term of how we invest. I want to highlight Amazon because it's one of our top pick into this year. It's one of the company we like the most. The reasoning is that it's for the first time or close to the first time, we're seeing AWS, Amazon Web Services, surging and doing quite well because of the adoption of AI. And that's coming at the same time that the retail business is seeing an inflection in profitability because they had invested a lot during COVID, and now they're gaining the fruit of all of that. So that's extremely powerful and positive for Amazon, as they will generate a lot of cash flow. And we do believe it's to a point that it's a company that will probably initiate a dividend this year. So in terms of, if we look at the Magnificent Seven, that's the company that we like the most here. And I just want to leave you with just a tidbit of performance. So if we look at 2024, a pretty good year for us. We delivered 40%, 4% about the index, and in terms of percentile, first quartile. Same thing in 2023. I want to put just an emphasis that I took control of the portfolio in 2023. I was involved as an assistant portfolio manager in the past, but I want to highlight that when I took control, I manage risk. I put risk management as a focus to make sure that year like 2021 and 2022, we would be able to manage downside a bit better. The style of the portfolio is the same. It's just that the risk management is more in focus. And with that, I'll leave it there since I went over time. Thank you very much, everyone.
Maxime, thank you so much for sharing your investment process. So as a summary, growth, stable inflation, and lower interest rates should be supportive to markets in 2025, but with cautious optimism. So that said, diversification continues to be the underlying theme in helping navigate through the possible uncertainties and delicate environment. So I would like to take this moment to sincerely thank all of our advisors for choosing IA. Your business means a lot to us, and we look forward to our continued partnership. If there's anything like questions or anything more we can do to assist you, please don't hesitate to contact your regional sales director. So again, my name is Hilda. I look after the province of British Columbia, and Angelina Barca, she looks after Ontario. Okay, so thank you very much, and I'll pass it on to Alex.
Yeah, actually, Maxime, do you have a few minutes for questions? Because we still have you guys slotted for about 10 minutes. So a question came out here. Maxime, as a portfolio manager, with all this noise in the United States about, Donald Trump, taking over Greenland and, Donald Trump wanting Canada to be, another state. Like what effect does that have on the market? So that's a question that came in, and if you could comment on that, and I'm sure many others would like to know what a portfolio manager's view is on that noise.
Um, if you look at Donald Trump's, I think it's important, and I will, as we navigate through the next cycle with Donald Trump as the power in the U.S., I would highly encourage everybody to go read The Art of the Deal, because that will give you a lot of sense about how he thinks. And I do believe all the talk that he's doing right now is just to start negotiation with a strong end, because that's going to be the anchoring start with any counterpart that he's have in terms of negotiation. So I'm not too concerned about it, but clearly what we're going to see, and we're already seeing it, is that's going to drive increased volatility in the market, especially when we look at we're having an high valuation, and you're going to bring all those tweet up and all those comment. So yes, I do believe it's going to bring volatility in the market. But actually, if you look at his last tenure, most of the time and on average, once he had a big announcement, you had a market pullback of average 1%, and 5 to 10 days later, we were back up to where we were before that. So that's really a signal of volatility, but on the fundamental, I don't think it's going to have any impact. And again, I want to reinstate that with the market at this valuation, fundamental is really what matters.
One good comment that my colleague Graeme Allan made backstage, because IA's thematic, you call it a core, it's a core fund, and if you could add to that, a US fund. So really the two managers we have on today, yourself, Maxime, and Patrick, your two funds can really work quite well hand in hand in a portfolio for, say, US holdings.
Absolutely. No, and we're both managers. It was my first time listening to Patrick, and we focus a lot on risk management. So I do believe that's really one of the key pillars you need to have when you want to have a core holding in terms of equity in your portfolio.
That's great. That's great. Okay, so once again, thank you, Maxime. Thank you for Hilda. That was really great, and we look forward to chatting with you both again soon. And thank you, Angelina, for joining us backstage today as well. So I'm going to just call upon Graeme Allan to come out on stage, and thanks once again to IA.
Hey, Alex. Thank you. Thank you very much. So we're now in the third part of the session this afternoon, and slightly different from the first two segments. You've seen a couple of product solutions that are available, or fund choices to use with clients. Alex introduced the reasons for the RSP season and why you still be embracing that with clients. Now we've got product solutions that we're looking at. So we have two fund choices, and we're going to look at something now, something slightly different. I'm going to introduce George Iovan because he will go into the product in a lot more detail. George, and really kind of guess the breaking news for us is George is now back on board with us, working as a really dedicated resource in Ontario and Atlantic Canada, which is nice to have. Probably a familiar face to many, but maybe some new friends on the line that should be speaking with George. And I think after this presentation, there'll be a real reason for doing so. So George's new title, official title, is Senior Account Specialist, Insured Investments, which is really quite nice to have that dedicated outlook. George has been with Desjardins since September of 2002, so entrenched in the product, knows the ins and outs of the contract, which is fantastic. That's what we want: consistency in a message that's delivered with the depth of knowledge and experience. And I know George, and any I've worked with him, he is dedicated to help building suitable investment products and portfolios and support, etc., that's needed to go on with your daily business. And I know prior to 2002, George was in the banking and financial services world, so brings a wealth of experience to the relationship. And I'm not going to say that old-fashioned approach, because I believe we are in a relationship business, and the face-to-face and depth of knowledge is something that's really, really important. So with that, I will pass it over to George to go into something unique and special that only Desjardins have. All yours, George.
Thank you very much, Graham, and everyone. Fantastic presentations from Alex and our colleagues at IA Manu. Great to be on the call again with one of my favorite MGAs of all time, IDC, because that's where I started way back with Ron Madzia, Greg, etc., and developed, and then we expanded the teams. So I'm really excited that I'm doing the insured investment, the focus only. I'm now connecting with people at IDC that I haven't seen in a while. I've been doing some stuff with Atlantic the last couple of years, though, mind you. So it's great. Now, what I'd like to talk about is a very unique to DFS product. It's a market-linked term investment that only DFS offers. So I'd like to go ahead with that. The presentation is called Untapped New Client Opportunities Using DFS Guarantee Advantage Market-Linked Term Investments. Again, another unique feature, only available in the insurance area in Canada from DFS. And we're going to talk about details of the February 2025 campaign, because every couple of months we have a new campaign that comes out to take advantage of for your clients. Some are not as generous, some are more generous, and they're great investment choices to consider for RSPs, TFSAs, LIRAs, etc. We can go over that later. But the whole idea is that I'm very dedicated. It's not about selling product. It's about dealing with advisors, helping them do the right thing for clients that's suitable, obviously, based on their profiles, and hopefully it's with products that I market to you. But I'm here to help you build your business and do the right thing with and the suitable thing for your clients, and hopefully my investment options, because we have seg funds, annuities as well, but Guarantee Advantage is a very, very center of focus for a lot of MGAs right now, because it'll be a little more clear as we go along. So with your permission, I'm going to start off with just to remember who we are, because a lot of times I get, oh, you're that green company. Are you with Manu? Well, no. We're Desjardins. We have the same coloring, but we're a proud, very successful group of companies that owns DFSIN, owns manufacturing, owns networks, etc. But we serve a lot of these independent relationships as independents. But we've been around since 120 plus years, since 1900. We're part of the largest financial cooperative in North America. Our AUM is approaching 450 billion Canadian. Still ranked one of the number one major Canadian banking institutions, according to Bankers Magazine a couple of years ago. And that's kind of a compliment to us, because we're really owned by a group of credit unions. And we're the first in responsible investment, having access to responsible investment strategies in Guarantee Advantage, and seg funds, Helios, mutual funds, ETFs. So have a very prominent position there, and we can offer those solutions in Guarantee Advantage for your clients as well. So the agenda, as we go along: growing your business at difficult times, beating the competition at their own game, helping you get assets from the banks. This is a bank GIC killer, I like to call it, using a ladder strategy to reduce risk for a client. And I'm going to go over after this how it really works, maybe in detail, maybe too much detail, and we're gonna have some questions. And I'm gonna give you the presentation after in PDF, and they already have it with the appendix on some very technical aspects that you may or may not want to hear about, right? So first of all, growing your business in these difficult times. What is that, and why is that for advisors today? Well, a couple of things are going on. You look at net investments and investment funds, and it looks like, and this number is probably changing back to more going in, but it's been the last couple of years, funds were going out, portfolio monies were going out, money market was going up, fixed income was going out, balanced funds, people were adjusting. These numbers are January 2024. Maybe it's skewed back to investing now, maybe not, into funds. But the big thing there's been a need for yield on the fixed income side. And that's where the pressure or support for guarantee advantage market-linked term investment has come from. People want a chance for a strong yield in lower risk options, right? And you look at the total deposits going back, into savings and premium checkings, high-risk savings account. We don't have a high-risk savings account option at Desjardins, but I know my colleagues at Manu, Dynamics, and they've got tons of money in there. But now the yields are going down, and they're looking for alternatives. Whether it's a PPN or something else, but a lot of them are considering guarantee advantage as that long short-term hold in those sorts of areas, right? And you can just see that market-linked term investors in market-linked GICs in Canada have gone up dramatically the last 7 years for sure, right? And they will keep on going up. But the main thing for us is that it's the banks that are doing this. Most of these monies in market-linked GICs obviously are coming in the bank customers, because a lot of people, they're playing on the fears of people saying, look, stock valuations are high. Look at the volatility in the S&P and the TSX, the MSCI World, the Asia Pacific. Why do you want to be in a fund? Go into a market-linked GIC. You're in the markets with no risk. You have a maturity guarantee. And the numbers are blowing out the doors for them in terms of increased sales. They also play on the idea of, well, hang on, what happens if you're in the markets, you're getting close to retirement, and there's a market drop of 30%, you have to make 43% next year to get even and going forward. So do you want to have your funds exposed to that, so to speak? Well, these products, the market-linked term investments, you're in the markets with no risk on death or maturity, 100% principal protected, and you're still in the markets, right? And if it goes down, don't worry, because at the end, you're protected. And that's what people want to hear. And that's why market-linked GICs are replacing equity plays in bank portfolios, it seems, right? To a large degree. Again, long-term rates, they're going down. They're looking for something with better potential over time. And guarantee advantage, proven track record, has done this in the past, and you can see it on the numbers going forward, that hopefully that'll continue. And that's where people are saying, yeah, it might not be a bad idea to kind of get out of that balanced fund and go into something like this, because it's proven, got some great options, great track records, investing in great companies and their performance. And again, this is the nail in the coffin for a GIC or a bond fund, or maybe not a bond fund, but even a long-term GIC, because look at the long-term rates. They're going down. Look at yields over time since 2019. They've gone up, and then bam, 2023 on, everything you can see, the 5-year federal bond rate, term savings rate, all going down. And that's what the future is going to bring. Long-term, short-term rates will be going down further. How much, we don't know, but they still have some way to go, we think, from our analysts, et cetera. Yeah, but equities at the same time, over time, they do make the right call. If you invest in them, why? Make it the right call, pardon me, because in the long term, everything goes up over time. Look at the S&P 500. Look at the S&P TSX 60 versus the 1-year and 5-year GIC, the little at the bottom here, those little two light blue and light gray things. So the idea is you're going to be in the markets, no risk. And long term, the longer you are, the more propensity or opportunities for you to outperform, especially versus a GIC or a term investment over the similar period. Wow. And again, I talk about beat the competition at their own game. Look at the competitive landscape out there in market-linked GICs. TD, BMO, RBC, CIBC, who I used to work for, and TD as well, years ago. They're marketing these products, market-linked GICs, and usually they don't have as many options because the providers of PPNs and market-linked GICs in Canada focus a lot on usually Canada, Canadian financials, utilities, maybe TSX 60. We do that as well in Guarantee Advantage, right? But we also are creative. We do consumer staples. We do global opportunities. We do ESG RI options, inflation proof. We're not afraid to come up with new ideas and new links to different bundles that we think would be more attractive to clients and give them diversification globally, US, internationally, etc. So at the same time, you got to remember that these products, let's say someone passes away. Well, unless there's spells or rollover, I guess, what happens? Well, they have to be market value adjusted, collapsed, sent to the estate for the whole process. It could be long, could be short, with costs involved, public process. With us, client dies, the Guarantee Advantage is below water, we pay 100% death benefit to the beneficiary. If it's down or up, we also give the beneficiary the choice in most cases, except in RSPs, where the beneficiary is not the spouse, to say, no, hey, this actually it's up. It's got 3 years left. Your dad bought a 5-year product. It's up 20% in 3 years. There's 2 years left. Assume the contract to maturity and all the interest earned from then on or lost, whatever, is still theirs. No disposition effect to the estate of the annuitant that passed away. So very estate planning friendly. And usually we have more generous options for clients with increased participation, which I will explain later on, if that's okay, more detail. So again, the banks are hammering your clients for this product. And it has been that way for years. So why not give them a estate planning friendly, usually more advantageous in terms of terms and availability and potential returns than what the banks offer. And it's an insured product that looks very good when you're doing your planning, because my goal is, or my aim is to help you. You do a great job on protecting lives with life insurance. Now let's protect their investments with life insurance like protection. It augments the perfect value offering, I think, for an MGA, an IDC advisor. He or she is doing the right thing, even more so, by looking at insured options for the savings and for the life side. So to me, it's a win-win in your value offering when you're talking to clients, to be honest, right? I'm still life licensed, so and I have some clients, but so that's the way I think. And again, okay, Georgie, I hear a lot about these things and the term of that, but what's it all about? The banks haven't, you're right. So assuming they're the same in terms of features, which are not, we usually are more advantageous. Here's the advantages the banks can offer in their market-linked GICs versus our market-linked term investors. Beneficiary designation, us, yep, them, no. That ensures prompt payment of the death benefit or assumption of the contract. Wow, they don't have that. It becomes a part of the estate. Protection from creditors and lawsuits, that's big, especially in open money. We have it. Certain preferred designations of beneficiaries allow the contract to be exempt from seizure by creditors, similar to a SAG fund. Do they offer this feature? Nope. Fees upon death? No. We have no probate to worry about, whatever. It's 100% death benefit goes to the client. Wow, private confidential within 5 days of usually the death claim being processed. With a market-linked GIC, if it has to go through probate, well, guess what? Probate, redemption, market value adjustment fees may be payable on these monies as they go along in the process. Do they have a guaranteed death benefit? No. We do. Deposit is 100% guaranteed upon the annuitant's death. They don't have this feature. And the other idea here is, I think we're the only insured option that has a 100% maturity benefit, death a maturity benefit and death benefit, and can be issued to the day before the annuitant's 95th birthday. Pardon me. I can give you $1 million, George, non-registered for John, Judy, joint, single, whatever, with a check, no medical. You can give me $10 million in guarantee advantage. And we still have 100%. Oh, they're 95, 94, one day before night. No, that's fine. No problem. No medical required. Like some of us have on the segment side, limitations of deposits clause where over $1.5 million, you need a short form medical. No, there's nothing here for that. Thank God, right? Give me a check for 5 million, 3 million, 100,000. We don't require a medical for that. Retirement tax benefits. The interest income here is eligible for pension income tax credit and or pension income splitting. GICs, no. Are they both redeemable before maturity? We say yes, because you can surrender it, but you're guaranteed not to get back more than your deposit because of the market value adjustment, similar to GICs. However, most market-linked GICs, they say they're non-redeemable, but you can still get out, but they have a market value adjustment, to be honest, process, to be fair to them, okay? Protection in the event of insured solvencies. They go, oh, George, GICs are protected by CDIC. Absolutely 100% correct. You're not absolutely 100% correct, but we're covered by Assurus, the old ComCorp, under the same terms that CDIC covers GICs. Also, guess what? CDIC does not cover mutual funds. Assurus covers mutual funds, segments, sorry, got excited. So yeah, it's win-win, protection-wise, client value-wise, ease of operation for the advisor. So hopefully, as I'm going along and thinking, wow, man, George has got a point here. These are good things to think about. Maybe have a client, Bobby or Debbie, you know, they'd be perfect for this. Performance. And we can give you numbers. Since 2009, if you go on Webby, you can see every issue that's been matured currently. Basically, it's had 4 to 5 campaign options, maybe more, since 2009 every 2 months. And 89% of them have outperformed the annual return of the main competitors' fixed rate term investments, all the matured ones, right? That's pretty good numbers. So they've beaten similar GICI terms over time. 98% have exceeded the annualized minimum return closer to the maximum. Wow. And 76% of options that have matured achieved the potential maximum return. And some of them have an unlimited return option, which they're not really maturing until this year, to be honest, those. But that's going to be even a better number to include in this calculation down the road. So, okay, George, sounds okay, but tell me more. Who are the target clients? Well, you probably have many of them in your client list right now. Maybe they're your life insurance clients that you don't deal with on the investment side. You have a great opportunity to sell them protection on the investment side now, insurance-based, that you maybe didn't feel comfortable. Well, seg funds, you know, they can go down a lot. And how do I explain that? They call me, they get upset. No, you don't have that worry here. But basically, it's conservative clients and GIC-focused investors. And you're going to give them that estate planning friendly feature on top of all this, right? Plus, usually some more generous options. Number 2, prospects that are still worried about where the markets are and the impact of a market correction on the retirement strategies. They're 62 years old. They're 60 years old. They're going to retire in 5 years. They can't afford to lose a penny on that great fund you might have given them, or they got at the bank or something. They don't want to go through 2022 in the year they retire, because you know what it takes to recover that going forward. So we say, yeah, we'll take that worry away. You'll never lose a penny, and you'll probably do very well given past performance in these options. But you never have to worry about the market correction at maturity. Wow, they're going to say thank you. That's great. Let's do it. You know, how about seniors that are looking for estate and tax efficient ways to transition their wealth? They're okay with GIC return, but they like a little more oomph to their savings. They're okay with that for all or part of their fixed income allocation, right? But you're going to give them that estate planning friendly feature, i.e. where in open accounts, and again, in RSPs or in TFSAs where the beneficiary is a spouse, if it's up and they pass away, the beneficiary is going to assume the contracts to maturity. I mean, this to me, so you must have many clients and you're thinking in your head of that you can talk to. I hope about this. And I'd love to, if you have high net worth and you want me to sit on a meeting, I'd be happy to sit in with even with accountants, because there's another angle here we can talk about in a second, right? A lot of, I just got recently requests for a ladder to remove risk and to allow for income every year, guaranteed income. Okay, let's look at it. Using a ladder, which is buying a step of different terms, right? In this case, who is it? Fit, so to speak. They want principal guarantees on the investments, don't want to lose any money, but they want a guaranteed income stream, minimum 20 years in this case, but they also want to have estate protection and to minimize costs on their death. Okay, investors that want to take advantage of an interest rate environment that's going up, well, it's not, this has to be adjusted, it's not going up as much now, it's actually going down, but still the same idea is there. 7-year retirement target, $200,000 to invest. He wants to get 5%, $10,000 income for 10 years guaranteed, but he wants to build an estate planning friendly strategy around this. Okay, so we said yes to him. Look, here's what I think it was a case of years ago. Here we go. We're going to put $40,000 into a 1-year GIA with us, which it says GIC, it's a term investment, insurance-based term investment, at the rate back then of 2.35, 40,000 into a 2, 3, 4, 5-year guarantee advantage with these rates. And some of now the 5-year or the 6-year has a 0 to unlimited, and the 5-year GA is probably 75.5% max. So 5-year plan, 1-year term, fixed term, and then every year what happens? It matures and they take their $10,000 out, and then they renew that remaining balance for 5 more years or 6 more years to keep the ladder going every year. So basically what it's done is, if the return is 0 per year, you're going to get $10,000 a year, basically, tax-free, I guess, right? In this case, with no return for 20 years. But then if the return is 3% per year, which, well, George just showed me something, and the number there probably was over 6% per year, right? Yeah. And some of the good ones, or there's even higher amounts, they're being accrued right now. It'll last for 30 years. Yeah. The more the performance, the higher the extension would be of the longevity of those funds. He's 70. Well, we can give him 30 years. It looks like at 3% annual income of at least $10,000 like he wants until then. And the higher the return over time, the longer the longevity of the funds, in case they want to start taking more money out every year. So 70-year-old retiree, 200,000 to invest, looking for 5%, 10,000 income per year. We're going to guarantee it for 20 years minimum. What happens? Here, we checked all the boxes for him. And the potential 10,000 per year minimum, and a chance to do more if the baskets, because we're assuming 0 in that one case, right, for 20 years. Wow. And you got a beneficiary designation, no risk to principal. I still have a chance for market growth higher than GICs and bonds. Wow. Sign me up, I would think. In most cases, they would say, hopefully. So I hope this sounds of great interest to you, right? And I'm going to show you now some of the nuts and bolts, not technically everything. But the whole idea is, how do you do this, George? Well, let me kind of cap over a few things first. There's a guaranteed minimum return. It could be 0, or principal return minimum at maturity, depending on the option selected. You'll see that we could have a 0 to unlimited, a 5-year 1.5% per year for 5 years, and a chance to make 30 and change, depending. We'll go over that. Access to baskets of securities of well-established companies that we will sometimes change every month, every 6 months, depending if we feel those are better fits in a consumer staples basket, financial basket. I mean, we have a Canadian financial institution basket now. We wiped out TD this time, so we won't have TD in there. They give higher return potential in the fixed term investment, as for the numbers I mentioned before. There's no ongoing portfolio management and no management fees. I'll explain that in a second. 100% guaranteed death benefit, can be surrendered anytime subject to market value adjustment, and you can have this protection and great vehicle for a minimum deposit of $500. Deposits can be made with 100% death benefit and maturity benefit up to the day before the client annuitant, he or she turns 95. Assures protection, which is great, and it's eligible for RSPs, LIRAs, TFSAs, everything. Does that sound cool? I hope. Now, on a macro level, how do you do this? It almost sounds too good to be true because I get those questions all the time. Not really. We do it. We structure the market-linked term investment guaranteed advantage the same way the banks do. The banks, except they don't have insurance costs to worry about. So what do? An issue comes out. It's going to be funded in February. Initiated. We have $10 million. We basically, I don't know the exact numbers, depends on the timing and the price. We'll buy a zero coupon bond through our trading desks to mature to 100%, high quality, mature to 100%, right? So the maturity guarantee is there. At maturity, you're going to get your 100% principal back for sure. That costs us, I'm going to lie to you, depending, let's say 96 cents per 100. Okay. Huh. The option strategy to capture this performance going forward, whatever it is, you know, we're going to buy to the maximum. If there's a maximum, we're going to sell the amount over that to someone else to lower the cost because we don't participate. All this money goes to your client. The strategy probably might cost, give or take, another penny and change, right? So you're now 97 cents. Oh, wow. We will pay you in the 5-year product 40 basis points per year upfront. So 5 times 4 is 2%. Under your life code, not your seg fund code. There's no grid here. So you sell a $100,000 5-year product, 2% goes in your account on your next weekly paycheck from IDC. The MGA gets a bit. They get some $12 or something per sale. It's not a lot. So now, hang on. What are you at? 96, 97, 99. Wow, 90 cents. We take between 42, usually 50 bips for a 5-year upfront as a part of our commission, no other costs after that. The rest, other 50, 47, 56 bips is going to be spent on insurance coverage for the death benefit in case you pass away and the zero coupon bond hasn't gone up to the proper value. And then admin costs, whatever the rest is, HST, we spend basically all the money and then initiate it and don't touch it until maturity. There's a clause built in though that we can look if they want, what they do, 90, 60, 30 days before to the price of the options. And if there's a whiplash, I guess it's called, where the markets are pulling back or the stocks are pulling back, they will take the money off the table to lock in the bidder. They have that option. And, you know, it helps, right? Although it didn't help on the ones that matured during COVID because the market pullback was so bad, we couldn't protect it. So hopefully that sounds like an attractive option to you. Consider for your clients. What's new this year in the February 2025 campaign? We added a 6-year term with unlimited return potential. RI for structured products is there, and we trying to be even more transparent with everybody. That's why the discussion of how it works. You'll see in the advisor guide, we go over this in detail, the structure, so you can say there's no MBRs here. There's costs to set up like the banks do their marketing GICs. And Desjardins DFS has some insurance costs to worry about, so their margin is going to be smaller because I would suspect that the bank margin, they don't take 50 bips, they probably take 75 to a point because they got more money to take from, right? And again, it's our way of trying to be innovative, give you products on the insurance side that no one else has out there. And the February campaign is available till January 17th. January 18th, the April 2025 campaign comes out. All I know is they haven't revealed it yet. We'll get the official campaign out probably next Tuesday. I can circulate it, I hope. But we know the 0 to unlimited 6-year will be available again. But let's look at some of the options now. I want to identify a few points. So let's say you tell me, like we have a 2-year, 3-year, 4-year, 5-year, and 6-year option. The idea principle is the same. They can have, let's say we look at, on the left-hand side, the financials, right? Well, the 2-year one, George, I got $10,000. Well, you're going to be in that first category. 2-year hold, 2 days, at maturity, 0 or up to 11% at 100% participation. George, what does participation mean? Sorry, simply, it should be noted as the amount of the return the client gets. Oh, so if I make X, I get 100% of X. Yes, in this case, there's a cap. You get everything up to 11% because we don't participate. We sell off, as I mentioned before, in the option strategy, any return over 11% to lower the cost of the option strategy. So in 2 years, I'm either going to get 0 back plus my capital, or up to 11% or somewhere in between. Yes. Well, I like financials should go up. Yeah, they've done well. They usually do 4 or 5% per year over a 10-year period, depending on what numbers you look at, right? Not including dividends or including dividends, a little higher. And then for a little more money, we give you a higher range. So I got $50,000, George. Well, we're going to give you 0 to 12.1. I got 250. I'm going to give you 0 to 13.25, but 120 participation in the 250, 110 in the 25 to 249.99. So it's easier to get 13.2. You make 10%, we make it 12. You make 11, well, we max out 11 at 13.2. You make 12.8, we max it out at 13.2. And then you've got some options, let's say in the global opportunity size, that have a minimum rate guarantee. And everyone up for 5 years has a minimum return of 1.5% guarantee. In the case of the 2-year global opportunities that at 100% participation, it's 3% minimum and a chance to get up to 8.5, which is 4.16 compounded. If you like that option, there it is. I like the idea myself of the 0 minimum because the range is higher, and I like global opportunities, for example. I think they'll do well over time, which they have to date. So I got 10,000, 0 to 12.5 at 100%. I got 50,000, 0 to 13.75 at 110% participation. Again, it makes 10, I make it 12.0. 250, 15. It makes 10, I make it 12. But the whole idea, as we go along, you can see, so if you're okay with the idea of participation rates, every year, what happens? The ranges go up all across the board. And the participation rates are the same in those different categories. They go up with the amount that goes up. So 3 years is pretty good. You mean I can put my $10,000 away on the right side in global opportunities and get back my money and up to 23%? I don't mind that bet, because if I'm in a mutual fund or seg fund and it loses money, guess what happens? I lose money. In this case, I get my money back 100% because of the guarantee. And the longer you're in, the longer the potential return, right? Here's the 4-year. Here's the 5-year option. You can see global opportunities, 0 to 74.5. You know, so if I hit that at 120 participation, so it means it's easier to hit that. If I want to make 60%, you make it 72, right? 1.2 times 60, yeah. Well, if I hit 74, 11.77 compounded, I'm going to be ecstatic because my client will be very happy, right? With no risk to their capital, look what we've done for them. And then most people like this option, to be honest. Now, we had a 5-year 0 to unlimited. The last 2 campaigns, including this one, no, we couldn't, it was too expensive. But 6 years, 0 to unlimited. Huh? That's too good to be true, George. No, we buy the options. There's options there to protect us. So I have 250 and over in one deposit. I'm going to get unlimited return basket return plus a bonus of 20% at the end. That's the contract. Wow, it sounds exciting. Well, and if you look on the system, the April 3rd, 2020 Canadian Diversified Basket, 0 to unlimited, matures probably in 2 months, right? April something 2025. It's up 73.19% or 14% with 2.5 months left to go in an up market. So just do the math, right? It comes in at 80 at 16% plus per year. Not bad. Interest income, tax deferred till maturity. Unlike a GIC, which every year you get a T-slip. So who's this good for too? People, your high net worth investors, him or her, that have millions of dollars in GICs, and they get this tax slip every year that wipes out their OAS. Well, you can help with that problem for 5 years. In the 6th year, oh no, you're going to get a big T-slip for that interest income on a $2-3 million GIC. But they're going to say, thank you, who cares? I got all this money, I don't need OAS. And then you can start the process again with them in the 7th year. And it's also good for passive income deferral concepts for Canadian small Canadian what's it, CCPCs, right? And if you talk to an accountant and ask them if they have any clients that need tax deferral assistance on passive income, they'll say, yeah, what have you got? Because they're all invested in GICs because it's retained earnings. And they get a TSIP every year. Oh, I have this insurance protected. What happens if it goes down? And the person dies. The annuitant, well, we give them back 100% of their money. Cool. So I'm saying that it's a nice option for you to consider if you have a client that fits, right? Oops, hang on. So here are the bundles. I should have maybe gone over these first. Canadian Diversified, you can see BMO, CIBC, Manu, IA's in there, good companies. No Desjardins because we're a mutual company. We're owned by stock owned by one company. So otherwise you'd probably be in a lot of these. We're environmental, social governance, ESG friendly, so to speak, global diversified baskets, some great names in there. The Magdas, Global Nordisks, you know, Texas Instruments, etc. I like the Vestas wind system because I'm an ESG sort of proponent. And then we have our global opportunities. Presently still, it seems, our most popular basket. Algonquin Power, Scotiabank, CIBC, again, Manu, CDIC, KDI Corp, McDonald's Corp, Nintendo. And then over on the financial side, we have that bundle again, but no Manu, BMO, Scotia, CIBC, Intact, Manu, National, Royal, Sun. Great institutions, great financials. At the same time, we don't leave you on your own. You've come to us, you come to me. We talk about, hey, we give you an advisor guide. We give you that support document I talked about with the performance numbers, right? The safety net. We have training videos. I don't understand call options, George. Here we go. How is the money actually invested? We have a video for that. How does it work? And if you don't like the video, read page 18 in the advisor guide. It goes over it in detail. And then we have the features table, which is updated, every time a new issue comes up. We have a fantastic client leaflet for you to send to clients. And if you click this, when you get the PowerPoint, it'll actually go to the site, right? If you're on the internet. We have a video, and I'm going to include that video. If you want, I'm going to send a Cole's Notes version of all this stuff if you want to, maybe through Graham or Laura, and they can send it out, or you can email me. I'll be happy to send it to you. We have a sales process checklist that helps you do the 1, 2, 3 of how to submit an application and what application you need, right? There's a term investment one and guarantee advantage for everything except Rrsp, TFSAs, and the one for TFSAs separately. Very user-friendly. And we have calculators. How can I target a higher return on my fixed income using GICs, term investments, and this product? We have a calculator. Even though it's not a fixed income product, we have an allocation simulator for RIFs or LIP income because we incorporate term investments, let's say for 5 years, and guarantee advantage to mature to 5 years to give you payments on a RIF for 5 years, and then you have to do the process again. We show you how to make this a RIFable product in a way, right? And then you want to track your return. You simply go onto Webby. I got the financials basket, came out in February 13, 2013. How did it do? I forget what it did. I did 26%, 4.73. Wow. So that is the summary. I hope I didn't go too long over, or not at all. But guarantee advantage, I think it's an incredible option to consider for your clients. There's value for them, estate planning wise, performance potential, relief of market fears for the advisor. It's an easier fit into a portfolio. You don't have to worry about the markets going up and down every day. And I think it pays nicely, which is not important, but it's also good for me because I help do the right thing for your clients in estate planning friendly, very, I think, potentially generous option for them that can never disappoint. Why? Because you know, either you're going to get your money back or a lot more in the end. And that's the promise. So you keep your promise. Clients like that, right? I know the risks. Oh, I got my money back. Well, my fund would have been down anyways if I'd been in the fund. So this is great. Oh, I made a lot of money. Cool. It's in my TFSA. Who cares if it's interest income versus capital gain, for example? I'm okay with that. So I look forward to chatting with anyone that would like to hear about this more.
Wonderful. Thank you very much. Complete and comprehensive as usual. We can't ask for much more than that, you know? So my personal things, I love the product. It's a fantastic thing to talk about, and when you bring in the insurance advantages you talk about, really will make a difference for the retail clients out there for use with advisors. So I'm just going to wrap things up for a couple of minutes and let everybody get on with their afternoon. I'd like to thank all the presenters, obviously. We're very fortunate at IDC to be able to access the top people to come and present to us at the notice that we ask of them. And there's a lot of effort and so on goes put on behind the scenes. So we're very, very thankful for that. Obviously, Alex opened up, my esteemed colleague. RSP season is not dead. There's obviously opportunity at this time of the year. People all of a sudden start to think about money. The adverts are on the TV. Social media goes wild with why you should still be doing your RSP specifically at the banks. So it's a product. It's something, a topic we don't want to have our clients talking to somebody else about. That's the conversations our advisors should be talking about as far as top ups and lending strategies. Moved on to Manulife. Obviously, the big news there is the new contract is out, and obviously speak to the Manulife wholesalers and the team there to get more information on that contract as it stands. Patrick, outstanding as usual. I had the pleasure of being around Patrick on a number of occasions, and I just love the demeanor of Patrick. It's thoughtful. There's nothing rash done there, and he did use the words consistency. Reliability in the presentation, which means a lot. And then one line that Patrick talked about, like a good fund with a good guarantee. That's what we're looking for any of the suppliers, obviously, that we're dealing with. But good fund, good guarantee, backed up by the power of the resets. On to Maxine. You know, this is a type of product that your younger clients are talking about. This is what top of mind to them. AI. I mean, I wrote down enterprise digitization. Never thought I'd ever say something like that in an investment presentation, but that's what's out there now. That's the disruption that's going on in the investment marketplace. It's the conversations top of tongue of a lot of people as far as AI goes and that type of topic. So definitely something that can work with if you're building a portfolio, maybe a slice of that with a kind of core holding, say like the Manulife product that we're talking about. And one thing that Maxine noted that came out there was he believes it's a stock picker's market in that type of product. So we want to make sure you're hiring the best type of people to do that stock picking on behalf of your clients. That's not your job. That's the people that do the in-depth data analysis. And finally, again, George, I'd like to thank George. He's not a portfolio manager, but probably one of the most enthusiastic people that we deal with in terms of helping advisors get revenue inside the door. That product is something standalone. Nobody else has it. And you know, really should be looking at that as a holding, as an entry point, even into getting into the seg fund marketplace. Get your clients used to the volatility, but have the guarantee and absolutely zero risk to their bottom line. So with that, we're at 3:08. I'd like to thank everybody for last year. As Alex mentioned, we had a fantastic year, and we look forward to another fantastic year in 2025. We're here to support the efforts and do what we can to help get the dollars in the door. So thank you, everybody, and have a great afternoon wherever you are.
Thank you, everybody. Have a great day and Happy New Year once again.
Thanks, Alex.